It's being played live now. So this live recording, I'm going to give you the link of it for you guys that join me personally tonight. And then you're going to get a text if you register your number. So you have to register your number. So let's start with that. Okay. Let's start with that. So I'm going to give you my cell phone number. Actually, you know what? All you have to do is click on that link. Okay. So look at the chat, please. Let's do this right now because we want to make sure that everybody's connected. This is the absolute best way that we communicate information to all of you. This, give me 1 second here. All right. So this text messaging service that we have, that we pay for, everybody gets a massive text message, a reminder about all the meetings that are happening so that you never miss a meeting, so that you know everything's going on and you stay connected, because the lowest level of commitment you can make in this business is showing up. Step number one in winning in anything is showing up. You want to win at the gym, you got to show up. You want to win in a football game, you got to show up to practice and show up to the game, right? If you don't show up to a game, what happens? You forfeit the game. You automatically lose. Just by not showing up, you lose. So how do you win in business? The way you win in business is by showing up. The way you win in your marriage, you show up, right? So stay plugged in, guys, every single time. But this messaging service allows us to stay together. So when you click on the link, this is what I want you to text. I want you to text the word live, life, or exam. Okay, life or exam, and that's gonna tell me to put you in this group. And then you get text messages for, like, for example, those people that are here, even if they were in the meeting that just happened, they got a text that says, hey, we're about to start a life exam prep class right now at 9 o'clock. It's a really cool way to communicate. Okay, so make sure you put that in there. Register your number. You have to, when you type in the word, it's going to send you a link. You got to click on that link and then register your number through that. Okay. All right, cool. All right. Let me go ahead and do something real quick here. Shown on video versus, okay. All right, so here we go. I'm gonna go ahead and share my screen, and we're gonna go ahead and get started with the life exam prep class. So here we go. Part of the life exam prep class that you should know. Hold on, let me move this around. How come I can't do this? Can't move it. Oh, there we go. Okay. All right, cool. So here we go. Log into POL. Okay, so POL. What is POL? POL is called Primerica Online, stands for Primerica Online. And basically, it's the service that you pay for so that you can have a virtual office and do business anywhere in the United States with it, from anywhere in the world, as long as you have internet. And POL is not free, right? It's going to cost you, I believe it's, well, it's $25 a month, but when you're an RVP, it's a little bit more. But you don't have to worry about the increase until you become an RVP. So this is how your page looks. If you're not licensed, this is how your page looks. And one thing that I want to share with you is there's links right here that you could learn about different things that you could do to win and to make money already. You don't need a license to make money. If you click on this link right here that says winning in Primerica, when you click on it, it takes you to these list of videos that you're able to watch so that you could start learning more and more about the company and Primerica. So I recommend that you guys check that out one of these days. Okay, not right now, but right now what we're going to do is, you see this gray box over here in the right side. When you click on it, it's going to take you to another page. Let's see if you guys could still see this. I don't know. All right, there we go. You guys should be able to see this. Okay, so right here, let me make this bigger because I know it's probably pretty small on your screen. Let me make this smaller myself. Give me 1 second, guys. I didn't realize that it was going to be so huge. There we go. All right, cool. So you see this cell phone in the middle? When you click on it, All right. It's going to take you to all the study tools that you have available to study with. Okay. And the ones you're going to focus on is these two right here, chapter quizzes and learn as you go. Chapter quizzes and learn as you go. These are the two sections that you have to be spending 90% of your time with if you want to pass this exam. So obviously chapter quizzes, it's what it says, right? Chapter quizzes allows you to study by chapter, and it's good because you could focus on the chapters that have the biggest questions on the exam, so that you could focus on those questions. What are the big chapters of the exam? Okay, so let's do that. I'm going to show you that right now. The way you do that is we're going to click on the middle section. We're going to go all the way at the bottom, and it says study by topic. When we click on that, it's going to be the intro section right there on select chapter. And when you do that, you go all the way to the bottom, and there it is. In the bottom, it says, look, this exam is 75 questions long, 90 minutes long, and you have to pass it with a 60%, which is easy. So here's the breakdown of it. If you notice right here, it says basic insurance concepts. There's 9 questions on the exam on basic insurance concepts. You see that? Let me go down again. There it is. There's 9 questions on the exam, which is a lot. Okay, because look, it's a 75 question exam, and you need 45 questions to pass. That's 60%. So if you need 45 questions to pass, oops, let me do something better. There we go. That makes it better right there, right? Is that better? Okay. So you need 45 questions to pass. So if you master basic insurance concepts and principles, then you already got 9 questions correct out of the 45 that you need. So you're almost like a fourth there, almost a fourth there. You're like 20% there. You see that? That's huge. That's a lot. Just one chapter, and there's like 13 chapters. Look at that. Look at this. There's sections that there's 10 questions on the exam. Types of policies, the individual life insurance contract. There's 10 of them. So just by mastering those 3 chapters, you already got 39 questions right out of 45 that you need to pass. You catch my drift? You see where I'm going with this? So how important is that? How powerful is that? So if you were me, and if I was you, better yet, if I was you, I would focus on the big sections of this exam. And so so you want to take a screenshot of this. Go ahead, take a screenshot of that. Ready? I'll give you 3 seconds. 3, 2, 1. And I'm going to go down the over here on types of policies and down. So go ahead and take a screenshot of that. 3, 2, 1. All right. And that's it. Look at Social Security disability program. There's 1 question on the exam on this section. Now, why the heck would you why would you give any of your valuable time to Social Security disability program? Okay, but you're the type that you gotta know everything. I get it. I know people like that, and there's nothing wrong with that. Only that, please first master the big chunks, the big chapters, and then go to study Social Security and disability program. Makes sense, right? So I'm literally telling you how to pass, guys. If you follow these tips, you will pass. No doubt about it. Super easy, piece of cake, slam dunk, home run, done deal. All right. So let's go back now to main menu. And then we're going to go to the pink, the gold cell phone. We're going to go to the gold cell phone, and then we're going to go to chapter quizzes, and we're going to study a big chapter, right? Types of policies. There's 10 questions on the exam on types of policies. I'm going to hit on that. And then we're going to hit on the individual life insurance contract. Remember, there's 10 questions on the exam on this one. So we're going to go ahead and do that as well. Like annuities is also a big one, by the way. And a lot of people have trouble, throughout the years that I've been licensing a bunch of people. Right now, we have 190 active licensed agents. I've licensed over 400 agents, right? A lot of them quit. They don't renew their license, which is mind-boggling to me, but it's okay. Humans are humans. Well, out of all those people, a lot of people have told me that the chapter that they have the hardest time with is annuities. I'm not going to go through annuities right now, but make sure, guys, that you study it and understand it. And when you get a video of annuities, that you go through it over and over until you're like, oh, okay, I get it. I understand what annuities are. Okay. So make sure you do that. All right. I'm going to keep my chat open as well. So if you guys have any questions or you want to participate or ask me anything, please do so. Okay. Make sure you register your phone number to the team text. Please do that. Okay. Don't forget to do that. Do that now. I mean, you know, people forget stuff, right? All right. So here we go. Let's do the individual life insurance contract. 10 questions on the exam on this section. So let's master it. Here we go. Number one, for how long is an insurance company allowed to defer policy loans or requests? By the way, you could unmute yourself. You don't just have to chat. If you want to unmute yourself and ask me a question, please ask. Don't hesitate. Okay. Don't hold back. Thank you. So for how long is insurance companies allowed to defer a policy loan request? 30 days, 60 days? What? Right here. Let me move this over here. There we go. Much better. So a policy loan. So this is for companies that have cash value life insurance. You could only pull out a loan if there's money, right? What kind of policies have money that you could pull out? It's called cash value life insurance policies. Okay, take notes, man. Write stuff down. I hope you have a notepad, your iPad, your cell phone, whatever, however you want to learn, however you want to take notes. Even if it's recorded, it's always better to take notes, right? You could review them after class in your own silent time because it's nighttime, right? The answer here, guys, is 6 months. I'll give you a little bit of time always to answer the question. So look, let me give you the scenario here for this question, okay? There is, thank you, Gloria. Thank you, Gloria. If you have a cash value policy that you want to take money out, you can, but you know what's going to happen, guys? Some policies could say, yes, I know you want your money now. Yes, I want my money now. You know why? Because I need it. I have an emergency. I need my money. Man, my voice is almost gone, guys. And then the insurance company says, oh, you need it. Well, I'm sorry, but I know you need it, but I'm sorry, but we're going to hold it for 6 months. That's how that works. Right? Isn't that crazy? That's how these cash value policies work. And one reason never to buy cash value. This is not going to be on the test. Okay. In the test, they're not going to ask you, should you buy cash value life insurance? They're not going to ask you that, but they want you to know how it works so that you know what you're selling. But we don't sell it. Primerica doesn't sell it. It's a ripoff. But anyways, some people know how it works and they still sell it. Can you believe it? Yes. Yep. They get paid big bucks for it. That's why they sell it. So that's how it works. What is a cash value policy? Write it down. A cash value policy is any type of policy that has a savings component built inside the policy. And here are the names. Whole life insurance, cash value. It's a cash value type of policy. Here's another one. You ready? Universal life. Universal life is a type of cash value policy. Write it down. Another one is variable life. Variable universal life is a type of cash value policies. Okay. So here's another one. Index universal life. So it's still universal. Anything that has a word universal in there in the test, they're referring to a type of cash value policy. Does that make sense, guys?
Are they attached to cash because they're index funds, or what is it exactly?
They're tied to cash because, all right, so I'm going to explain it, but while I log in, because it's much better if I write something down, okay? They're cash value policies because they're tied to index, not necessarily. Index universal lives is how the index part is how it grows, right? It's how it grows. It's attached to an index, so it kind of mirrors the index, like the S&P 500. So it grows, but it doesn't. But that's not the reason it has cash value. It has cash value because it has a savings component inside of it, and that savings is invested either in an index or in a fixed account or in mutual funds, which is the case in variable universal life policies, right? Whole life insurance usually are invested in fixed accounts. It's like a guaranteed return. You know what I mean? So it's invested in guaranteed. Yeah, by having my iPad here is going to help me show you this, right? So a cash value life insurance policy works like this. You have, let's say $300,000 in coverage, and you're paying, like a term insurance, by the way. If you were to get a term insurance for $300,000, it will cost like $50 a month or something like that, right? Now check this out. Check this out. If you get a whole life insurance policy, the payment is going to go up significantly, like $250 a month or something like that. Why does it go up so much? Because some of that payment goes to pay for not only the coverage, right? Because the $50 is for the coverage, but some of that payment, it goes to what's called the cash value. Cash value. And the cash value is basically savings, right? But they can't call it savings. You can't. It's illegal. In a life insurance policy, is called cash value. Cash value. All right. And once you start building it, let's say you build up a good $10,000 and you need it, you could take it out. So that's, I guess you could say that's a positive thing, right? But then if you take it out, they could hold it for 6 months. That's what this question is all about. Not only that, they're going to lend it to you. You see how it says a loan right here?
Right.
They're going to lend you your own money. So you're going to pay interest to borrow whose money? Your own money. So I mean, they're crappy, right? But the thing is that they want you to know how it works. Even if you're not going to sell it, but you're going to replace it. There's going to be families that are going to have whole life policies, universal life policies, index universe, that you could replace those policies and show them a better way to do it, which is buy term and invest the difference. Make sense?
Okay.
So it's really cool. Keep on asking questions. That was a good question. All right, now we're going to go to the rationale. Guys, always read the rationale, okay? The rationale, yes. Sorry about that. The rationale says, insurers writing variable life insurance policies may defer the loan request for up to 6 months. This excludes loans requested used to pay policy premiums. So it's crazy, right? No más a lo que le conviene, only what benefits them, right? It says if they owe money, they could, if they owe money, I'm sorry, if let's say they owe premiums, they're behind on their monthly payment, the $250 a month, and they're behind 2 months, so they're behind $500. So if the client could say, hey, I want to use my cash value to pay for my premiums, the $500 that I'm behind, then you know what the insurance companies do? It says right there, right? It excludes loan requests used to pay policy premiums. So they'll give you the money right away because they're getting it back. It's premiums. Questions, comments?
Does this affect a customer's, score credits?
Does this affect a customer's credit score? The answer is no, it does not. So let's say you owe money to them. They'll take away they'll take the money you owe them from your cash value. But the savings to get one of these policies, it doesn't require good credit or bad credit. It requires good health and money. You have the money to pay for it, and are you healthy? Are you healthy? Good question. By the way, I know some of you are not from California, and this information is in all the exams on all. What's that mean? Yeah, you can sit here. This exam is this concept of the topic that we're learning about today is going to be on the exam on every country, every state. So what's the difference? Because every state is different. Okay, the difference is the laws. Like, for example, which we're not going to go over, like the penalties. Like in California, if you like a replacement, like when you're replacing a policy, and if you don't do the replacement, the notice regarding replacement, you get fined $1,000, right? In California, but maybe in Texas is $500. Maybe in Illinois is $5,000. You know, every state is different in terms of that regard. But in terms of like variable life, in Texas, it's a variable life. In Ohio, it's a variable life. Cash value is the same in all the United States. Does that make sense? So this is a topic that is universal on all exams. So it's good to know this. Okay, let's go. Good questions. All right, number 2, when the insured selects the extended term non-forfeiture option, the cash value will be used to purchase a term insurance with what face amount? A, the same as the original policy minus cash value. B, equal to the original policy for as long as the cash value will purchase. C, in lesser amounts for the remaining of the term of age 100. Or D, equal to cash value surrendered from the policy. Equal to the cash value surrendered from the policy. All right. So what is a non-forfeiture option? First of all, if you don't know what a non-forfeiture option is, then you're not going to get this question right. Okay. First, you got to know what a non-forfeiture option is. What is it? A non-forfeiture option, let me give you a scenario. Okay. Let's say you have the same $300,000 cash value policy and you have $15,000 in cash value, but then you lost your job or you became disabled and you no longer could afford the $250 monthly payment. You with me so far? If you can't afford it, then does your policy cancel? No, you have that's when you exercise your non-forfeiture options. Okay. So what is a non-forfeiture option? You tell the insured, hey, you call, let's say Prudential, right? You call Prudential or State Farm and you say, hey, Prudential, I got in a car accident and I'm disabled and I can no longer make $250 a month, but I don't want to lose my policy. What do I do? And then Prudential is going to say, hey, not a problem. It happens. Good thing you have $15,000 in cash value. And we're going to give you a non-forfeiture option. You choose which one you want. In this case, this one is called the extended term non-forfeiture option. Okay. The extended term non-forfeiture option works like this. Okay, you write it down in your own notes. Okay. And again, you can watch this replay over and over because I know this Chinese, especially if this is your first time. Extended term works like this. You're going to get an extended term. So it's not going to go to age 100. This is used on whole life policies. Extended term is going to give you the same coverage, $300,000, but it's going to use the $15,000 to pay the $300,000 for an extended term. So it's kind of like term insurance. You see what I mean? So couple it together. Extended term is like term insurance. So it kind of turns into a term insurance policy, but it's still a whole life. It's just using the cash value to pay for the premiums for an X number of years, but not to age 100, not to age 100. Okay. So now that you know that information, what's the answer? Let's read them again. The same as original policy minus the cash value. So the question is, what will be used to purchase term insurance with what face amounts? What will be used to purchase a term insurance? The cash value. With what face amount? The same face amount. So A sounds like the right answer, right? Yes. Okay. Let's look at B. Equal to the original policy. There it is. Equal to the original policy. For as long as the cash value were purchased. Ooh, you see, B sounds a lot better. A sounds right, but B sounds a lot better. Equal to the original policy, so equal to 300,000. For as long as the cash value will purchase. Yep, for as long as the $15,000 will pay. B sounds like the best answer, guys. But okay, here's another tip. Never answer the question until you read all the answers. Okay, because look at this. You could have thought A was the answer because A sounds pretty damn good. But you click on A, you're going to get it wrong. Okay, let's go with C. In lesser amounts for the remaining policy term of age 100. Now, It's not going to go to age 100, and it's not lesser amounts. It's the same amount, 300,000 coverage. And then D says equal to the cash value surrender from the policy. So the cash value is 15,000. Is it going to, so it's going to go from 300,000 to 15,000? No, that doesn't sound right. So right here, I'm going to put the answer B, and boom, there it is. It's B. Okay, so let's read the rationale. Let's read the rationale. Any questions here? Let's read the rationale. It says, with this option, the cash value used as a single premium to purchase the same face amount, 300,000, as the original policy for as long a period of time as a cash value will insured against. Hey, how do I sound, guys? Do I sound too loud? Because
yeah, it's a little bit too loud. It's a little bit too loud.
All right, I want to bring it down. Sorry about that. How did it sound before? How about now?
It sounds fair. Sounds fair.
Sounds fair. Okay. I just wanted to be clear, especially because sometimes the sound sounds really far in other recordings that I've done in the past.
Right.
Okay, so extended term non-forfeiture option. It's gonna come up. There's the other type of extended. I mean, the other non-forfeiture option is, I don't remember right now, but it'll come up. Okay, so we'll go. Let's go. Es más, I'll give it to you as homework. What is the other non-forfeiture option? And the other non-forfeiture option, I don't remember how the title of it, but I know how it works. The way it works is that the cash value, the 15,000, pays for the whole life till age 100. But obviously, because it can't pay the 300,000, it's going to decrease the coverage, but it's going to pay to age 100. The cash value is going to be used to pay the reduced face amount till age 100. Oh, it's called reduced paid up non-forfeiture option. Write it down. Reduced paid up non-forfeiture option. Write it down. Cool. Cool. Oops. What happened? Let's go to the next one. Number 3. An insured misstates her age at the time of the life insurance application is taken. The misstatement may result in A, automatic lapse, B, rescission of the policy, C, adjustment of the amount of death benefit, or D, no change whatsoever. An insured misstates her age at the time of life insurance application was taken. What you guys think? All right.
I'm thinking A or D.
Automatic lapse or rescission of the policy. Okay, I'm gonna go with C. And the answer is C, guys. Why? Okay, so this is kind of like it's not fraud, right? A and B is a result of fraud. The policy lapses, it cancels a policy. It rescinds the policy, which means it canceled the policy.
Right.
But in this case, it's like tobacco. Let's say you smoke tobacco and you say, nope, I don't smoke. I'm not a smoker. I've never touched cigarettes in my life. So you kind of lied, right? But then you die and they find out that you were a tobacco user. What happens? Is that fraud? This is kind of tricky. It sounds like it is fraud. Yeah, it sounds like, of course. It sounds like it is fraud, just common sense, right? But in the test, it's not fraud. In fact, in the real world, it's not fraud. What happens in tobacco questions and misstatement of age questions, they just adjust the amount of death benefit. They just adjust it. They still pay the death benefit. They still pay it, but they won't give you what you wanted. They'll give you what you would have qualified for at that age, or if you were a tobacco user.
Oh, well, question.
Yeah, go ahead.
When it says adjustment,
can you repeat that again, please?
Is it in most death benefit? When you say that it's an adjustment because
it's an adjustment
about her age.
It's an adjustment in the death benefit.
Yes, I know. But what I'm saying is that the word adjustment, does that mean that it could be either more or less?
It's gonna be less. It's gonna be less because a tobacco user, the cost is higher.
Right. Oh, okay. Well, yeah, tobacco.
So
But I'm saying age. What I'm saying in terms of age.
in terms of age, it could go up or down depending on the age. You're right.
On the age,
So
okay. Yeah.
yeah,
You're
if
younger, obviously. You're younger.
they're younger, then they would give them more coverage.
Oh, okay. All right. Yeah, that's what I want to know regarding the age.
Yeah, good point. Good point. Actually, that's really good point. I haven't seen a question like that one, but it's good to know. If they misstate her age and she said she was older than she really was, then she's actually getting more money.
Oh,
If she says, nope, I'm younger than I really am, so that I could get cheaper rates, then it's going to be less coverage.
right.
All
I mean, I
right.
guess that particular, I mean, in order not to make a mistake in terms of age, I mean, doesn't the agent ask for ID in terms of applying?
Yep. When you fill up an application, in fact, the closing process works like this. So which of these three would you like to see if you qualify? That one. Okay, great. Can I see your ID? You ask for the ID and boom, you start the application.
Okay.
Good point. Good point. All right, let's go to the next one. Next one. Here we go. Which of the following is not typically excluded from life policies? Self-inflicted death, death that occurs while a person is committing a felony, death due to war or military service, death due to a plane crash for a fare-paying passenger.
D.
Which of the following is not typically excluded from life?
So right here,
Plane crash.
yeah, right here, the answer is D. And you got to remember the acronym WASH. Oops, what the heck?
Wash.
WASH.
Yeah.
Yeah. Have you ever heard of WASH?
No.
This acronym will help you remember this answer. WASH. W stands for active war. There it is. War.
Okay.
A is for aviation, but it's a trick question right here.
Right.
Because this one is saying what makes it not aviation, plane crash, right? It's a fare paying passenger.
Right.
And that's what makes it right. If it didn't have fare paying passenger, then that would be also excluded, an exclusion.
Right.
S is suicide, that's self-inflicting. Right. And then H is hazardous sport or something hazardous, right? Like committing a felony.
Right.
Got it?
Yes. Yeah. Fair pay. Yeah, I read that pilots get to pay more.
Yeah, jet pilots, their life insurance premiums are expensive. Under an extended, oh, here it is again, extended term non-forfeiture option. You learned this, guys, right?
Yeah.
The policy cash value is converted into what? Go ahead. Give me an answer.
Cash raise. Oh gosh. Not just extended. I'm lost with so much in it, so much work. Higher.
All right, here we go. You ready?
Ready.
I can't see your chat, so maybe some of you guys are answering on the chat. Sorry about that. Let's open up the chat here.
Oh, okay.
The answer is B. Remember this, extended term keeps the same coverage, but it's not going to go to age 100. It's going to be a shorter period of time. How short? Well, depending on what it depends on what the cash value could buy. For as long as the cash value lasts. Okay. So that's B, the answer, the same face amount, right? As a whole life. So basically converts it from whole life to term. All right. But it's the same face amount, but it's going to be less time. Until when? Until the money runs out, the cash value. All right, number 6. Number 6. All of the following are beneficiary designations except contingent, primary, specified, tertiary.
Specified.
Yes, ma'am. The answer is specified. Congratulations. Great job. Beneficiary designation determines the order of which benefits will be paid. Primary, which is the first one. Contingent, which is the secondary beneficiary. And it may include a secondary and tertiary, which is like worst case scenario. Usually most policies go just primary and contingent, and that's it. Any questions? All right, let's go to the next one. Number 7. When a policy owner specifies a dollar amount which installments are not to be paid, he or she has chosen which settlement option?
Policy owner. Question.
Go ahead, question. Go ahead.
When it says policy owner, it's talking about insurance, correct? Or not necessarily?
The policy owner is the owner of the policy.
Yeah, but what I'm saying, it's since it doesn't specify, is it annuities or life insurance?
Oh, you're right. A policy owner could be it could be an annuity, or it could be a life insurance policy.
Oh,
you're right.
That's tricky, but
yeah, it is.
a little
But right
tricky.
here, look at the settlement options in life insurance and annuity are pretty much the same. Jargon. Fixed amount, yep, that applies to annuities and life insurance. Extended term, the extended term is a non-forfeiture option. It's not a settlement option. Remember that. So C, you could take C out of the equation. Makes sense? And then life income period certain, that applies to life insurance and annuities. So don't worry about being tricked in that regard, because the settlement options are pretty much the same on life insurance as they are in annuities. So that should help you. All right, I got a D, fixed amount. So policy owner specifies a dollar amount. Great job, Shakira. You got it right. Good job. The answer is C. The policy owner or the client says, hey, I got, let's say it's on the life insurance side, example. My wife died and I got $500,000 and I want to get $10,000 for life from this. I mean, $10,000 until the money runs out. So right, look at what it says right there. The policy owner specifies a dollar amount. I want $10,000 a month. That's fixed amount. Okay. So the word amount is in the word. The amount is in the question. The amount is in the answer. Okay. What if the client says, I don't want an amount. I want this money to last me for 30 years. Then that would be fixed period. Because now the client's choosing a period of time, not a dollar amount. Questions? All right, let's go to the next one. It'll take a while, man. It took me a while to understand that one. If you got it right away, then good for you, man. That's awesome. Which of the following statements are true about a policy assignment? So right here, they want to know if you know that word in your vocabulary. Assignment. It authorizes an agent to modify the policy. It transfers rights of ownership from one owner to another person. It is the same as a beneficiary designation. And it permits a beneficiary to designate the person to receive the benefits. Ooh, man, this one's tricky.
I've lost you.
It's okay. So help me out. All right. I need help on this one. Is it B or is it D? All right. So by majority rules, I'm gonna go with majority rules. D. Ooh, it's B. So B, let's read the rationale. The policy owner may assign a part of the policy, collateral assignment, or an entire policy, an absolute assignment. Oh, okay. So this was a trick question. They totally tricked us. Me too. So right here, it's not saying whether it's a absolute assignment.
Okay, a question.
Or
A
hold
question
on,
again.
buddy. Hold on, brother. Hold on. It's not saying whether it's a absolute assignment or a collateral assignment. It's just saying assignment. And that's the tricky part of this question. Go ahead, ask your question, brother.
Oh, yeah, again, it could be either life insurance or annuities.
Yes. Wait. Absolute assignment. Nope. Assignments are only on life insurance.
Oh, okay.
Yeah. Good question.
Yeah, that's,
What is the same on annuities and life insurance? Settlement options. Same.
right.
Okay.
The only thing is once when you die, the other way you'll live.
Another thing that's the same in life insurance and annuities is the word variable. Variable annuities, variable life. Okay. That's also the same. What does variable mean? Variable means that the money's invested in stocks and mutual funds. It's in a separate account. You need a securities license to sell anything that has the word variable on it. Okay. Index is also another thing that's the same as annuities and life insurance. Index universal life or index annuities. What does index mean? Index means that it's invested in an index fund. All right. Like the S&P 500. Right. So if you see the word index, you should connect it with the word S&P 500. All righty. Yeah. So the policy owner may assign part of the policy or the entire policy. So B says it transfers the right of ownership from one policy to another. That's exactly what the word assignment means. It was going straight to the definition of assignment, which is B. D, the reason it's not D, even though I thought it could have been D as well. It permits the beneficiary to designate the person to receive the benefits. Well, that's a collateral assignment. It's part of the benefits, not the entire benefit, right? It's part of the benefits. So D is collateral assignment. B is assignment. All right, let's go to the next one. Good, tricky question. Let's go to the next one. All of the following are non-forfeiture options except, here we go again, non-forfeiture options. So you could pretty much cross out A and B. Come on, guys, right? Extended term non-forfeiture option. We already went through 2 questions on this. Reduced paid up. Remember I explained to you that it reduces the coverage and it's paid up to age 100. So is it C or D?
Oh, I say D. I take a wild guess.
You're a wild man. It is C. Non-forfeiture values include cash surrender, extended term, and reduced paid up. Interest only is a settlement option. Screenshot this puppy right here.
Settlement option. Okay.
So the test definitely wants you to know the difference between non-forfeiture options and settlement options. Interest only is I want my money. I want my money to just be paying me interest. Interest only. Cool. All right, let's go to the next one. Number 10, if a policy has an automatic premium loan provision on, what happens if the insured dies before the loan is paid back?
If a policy is an automatic, what happens if the insured dies before the loan is paid back?
Okay, so what happens if the insured dies before the loan is paid back? The policy beneficiary takes over the loan payments? No, the policy is surrendered, null and void. The balance of the loan will be taken out of the death benefit, or the policy beneficiary receives a full death benefit. The answer, guys, is C.
C, yeah.
Okay, the answer is C. So basically, if let's say the death benefit is 300,000 and the client owes owes $5,000 in loans because they pulled out a loan that they could get 6 months later and they're going to pay interest on, right? They
Right.
pull out $5,000 and then they die. What
Right.
happens? Well, 300,000 minus 5,000, the beneficiaries are getting $295,000.
Right.
Crazy, right? It's their money.
Question.
They're taking it out of the benefit, but that's how it is. Go ahead. Question.
Quick. Yeah. This will also apply with the credit life, right?
This applies to credit life.
Credit
Oh,
life insurance.
all right. Credit life is a term insurance. So no, it doesn't apply because right here we're talking about a cash value policy.
Oh, okay.
And credit life is not cash value. Credit life is term insurance.
Oh, okay.
Yeah, but
Oh,
I like
yeah,
how you're making the connections, right?
Right.
So now let me explain what credit life is to everybody that's on the call. Credit life is a life insurance policy that a creditor like Bank of America will force you to get if you borrow money from them.
Oh, okay.
So that if in case you die, they get their money.
Right.
All right, let's go to the next one. Number 11, which of the following explains the policy owner's right to change beneficiaries, choose options, and receive proceeds of a policy? The entire contract provision, the consideration clause, the assignment rights, owner's rights. This one gets me all the time. Let's see if I can remember. Which of the following explains the policy owner's rights to change beneficiaries, choose options, and receive proceeds of a policy?
Yeah, I would go with C or D, but
All right. Right here, guys, the answer is, I don't know.
is it C?
You tell me. Okay, explains the policy owners change beneficiaries, choose options, and receive proceeds of the policy. I think it's the entire contract. Oh, owner's rights.
Oh, owner's rights. Okay.
All right, so let's read the rationale. Policy owners can learn about their ownership rights by referring to the policy. Yeah, this one I didn't know. All right, let's go to the next one. Any questions? No. All right, thank you, because I wouldn't be able to help you.
Yeah.
Number 12, the dividend option in which the policy owner uses dividends to purchase a term policy for 1 year is referred to as accelerated endowment, paid up additions, 1 year term option, paid up option.
The dividend option policy for 1 year is referred as a. Oh, I think I remember this one.
The dividend option that pays policy owners uses dividends to purchase term policies. So this is, oh man, paid up addition. 1 year. Yeah, it's in the question. It's in the
Yeah,
question.
it's C, letter C.
It is definitely C. It's in the question.
Right
The dividend is utilized to purchase 1 year term insurance. It says 1 year term insurance, 1 year term option. Simple, right?
Yes.
Okay, something about dividends that you should know. Are dividends guaranteed? Who can answer that? Are dividends guaranteed? The answer is no. The answer is no, dividends are not guaranteed. Dividends, you may get them, you may not. And it sucks because dividends, what's the definition of dividends? Dividends is an overpayment of premiums. It's crazy, right? So you are overpaying in premiums and it's not a guarantee that you're going to get your overpayment in premiums back. All right. Is that going to be on the test? No, but you just have to know that dividends are not guaranteed and you can use dividends if you do get them to do all these different things like 1 year term, paid up option, paid up additions. You could get more coverage for until age 100. You could get it back as cash. You could earn interest with the dividends, stuff like that. You could reduce your premiums with the dividends. All right. Well, guys, you know what? It's 9:53, and we did take a little bit of extra time on these questions. Always, whenever you do a quiz, always review the questions you got wrong. Right here, we got 2 questions wrong, right? Let's review them. Which of the following statements is true about policy assignments? B. The answer is B. It transfers right ownership of the owner to another. So they tricked us in the way that they were asking just the definition of assignment, which is B. 11. Which of the following explains the policy owner's right to change beneficiaries, choose option, and receive proceeds of a policy? The answer is D. Owner's rights. Owner's rights. Owner's rights. Yeah. All right. So before you leave, I'm gonna give you the link for this class. I'm gonna give it to you now because the one I'm gonna send out to everybody is gonna be there it is. Go to the chat, please, and copy that link, because once the webinar ends, you're not gonna have access to the chat. And I'm also gonna, if you registered your cell phone with Team Text, then you're gonna get a text tomorrow, like at around 9-10 a.m. with the same link, and you're gonna get a daily video of these that we recorded. So make sure you register your number on Team Text by texting the word, just in case you weren't here when I said this, by texting the word exam. All right. Texting the word exam.